So hi there and welcome to my channel. This is Morris with San Jose Options. I'm also the founder of Option Color Software. And today we're going to be looking at the winners and losers of last week. For the last week, we're looking at SPX, and SPX moved up 1.4%. And so what I've done is I've created 3 different trading strategies, and we're going to put those trades on in a paper trade, and then we'll fast forward the week and we'll see how they performed, and we'll talk about the differences. So the first trade we're looking at is a Strangle. This is on Friday, January 26th. So again, let's say you put this trade on just before the market closed, and then we'll leave it on for a week. And then again, SPX moves up 1.4%, so it's going to move up to about here. And this trade, looking at the bottom here, we'll see it has a theta of 506 per day. And again, that's why people are so attracted to this short strangle strategy. We'll also note that your Vega position's about negative 3.7 thousand. I'm starting the trade with a relatively flat delta, and you can see the gamma. So this trade at most brokers will be something like around 20,000. Again, they have their different formulas for that. So that's this trade setup. Then we're going to set up a calendar which looks like this. And so this one, again, I'm comparing trades that are about 20,000. So this one, about 21,000. Vega position is positive 2.2 thousand. Your theta is much less at 167, and your gamma is pretty flat, but a little bit. And then I set up the short iron Condor, and I think this is a really interesting trade because if you read around the internet, everybody says that your long theta trades, time decay, selling options, makes more money, so on. So this trade has long Vega 3.7, but look at your theta position. It's negative 354, and your delta's pretty flat, slightly negative. And then your gamma position is positive here. So instead of the frown that we have on the others with the risk profile, we have this smile shape. And so you would think this type of trade would require a pretty large move to beat out this theta position that's negative 354. So let's go ahead and we'll go back to the Strangle, and then we'll see how it performs on a day-to-day basis. So here's the first day. And we see the SPX moved up 0.76%, and the trade is down 1,260. And the second day, the trade bounces back to almost break even, down $90, and SPX was almost unchanged on that day. Then the third day, you have a positive reaction. It's up $420. When SPX went back down 1.61%. Then Thursday here, February 1st, the trade's up $390 with a 1.25% move in SPX. And then today, with SPX moving up another percent, the trade once again falls over $2,000 on this day. And so after a week in this trade, even though your theta position is hovering around $600 per day, so you would think you would be up maybe $4,000, it's actually down $1,755. And SPX barely even moved, only 1.4% during that week. So again, lots of people are attracted to these high theta trades, in this case the short strangle, and they expect to make a lot of money from the theta position. But here's an example where SPX really did what you want it to do. You would figure volatility might drop a little bit since it didn't move and it went up a little bit here, but to the contrary, this trade is down $1,755. So now let's move over to the calendar, and actually let's go back in time to last Friday, January 26th, and then I'll switch back over to the calendar, and then we'll do the same thing. Okay, so this trade starts at 0, and 1 day ahead, the calendar is up 1,500. Okay, and this is interesting because SPX moves up 0.76%, and the calendar is making a profit. Now again, you would think that the calendar would be losing, but that's assuming the volatility is going down. But you have to understand that at this time in the market, vols are already pretty low. So there's no guarantee it's going to keep dropping. So here we're Tuesday, and this trade is still up 1,500. Wednesday, the trade moves down, and now it's lost 2,400 on that day, and it's down 900. So again, we see one thing with this calendar, a bit of volatility as the price moves left and right. Thursday, we get another fortunate move to the upside. It goes up 2,750 on that day. And now the trade's up 1,850. And then Friday, we move up again 1%, and it makes another 1,650 on a day. It's up for a total of 3,500. So again, this is really interesting because what we saw with the Strangle was market didn't move that much, or SPX only 1.4%, but it lost money. Now this one, this is a long Vega strategy with the calendar, and again, the underlying is the same, moved at 1.4%. This one doesn't have nearly the same theta as the Strangle, with 211 finishing theta, but somehow it miraculously made $3,500. So again, that would indicate that the volatility has actually been increasing. So let's take a look at the iron condor. Let's go back and see how it performed. Again, it's a short iron condor. And so in this case, again, we have a theta position that's negative 354, and then we'll go day by day and see what happens to this particular trade. And we see on the first day, it's actually up $1,610. We have a 0.76% in SPX to the upside. Day number 2, SPX doesn't change much. Looks like vols drop and trade goes down 1,380, but it's still up $230. On the next day, we get a drop in SPX by 1.61%, and it profits 805 on the day for a total profit of 1035. And Thursday, we get a move to the upside, 1.25%. And on this day, wow, exactly back to break even. And then moving on to Friday, we have another move up of 1. And the trade again moves up 26.45. So we finish with a decent profit of 2,645, or 12.85%. So to summarize, we have that profit there. The calendar has made 16.44%. And then the Strangle here lost 8.76%. So it's actually a really interesting discussion that, the price of SPX went up a little bit, but the volatility must have increased, which is a little bit backwards because typically there's an inverse correlation with price and volatility. But this week, as we went sideways and up just a little bit, we saw an increase in volatility. And so that's what could happen when vols are a little bit lower. So before we go, let's take a quick look at the price chart so we can just see what happened during these trades. So here we are, and we see that we started right around this point here, and the price went up a little, down a little, and back up. So it didn't really move that much, but I just wanted to show you the price action before we go. And take one little look at the volatility. And so here we are, and the blue line is the implied volatility, and we can see that we again went down a little bit and then back up, but not such a huge change, but we did go up a little bit. So there you have it. What did you think? Were you surprised? Did you think that the Strangle would make the most because the market didn't move much and its theta is just so much greater than the others? Were you surprised that the short Condor didn't lose with such a large negative theta? And how about that calendar? You know, making money as SPX moved up. You would think vols would drop and maybe it wouldn't happen, but very unpredictable behavior of these options in this week. And I think it's really interesting study, and it just shows you the impact that volatility can have on your trades much more than theta. You know, I like to say that theta is like a mirage, and you can see why. You know, so much theta on that Strangle here, and for this trade to lose $1,755 with all that theta, over 600 per day, I just think, you know, it's eye-opening how your theta is really a mirage, and it fools so many people. That's why, you know, at SG Options we trade and we teach volatility, because that's where the money's really coming from, and hopefully you're able to see it from this example. So once again, if you like this concept, let me know and I'll create some more videos for you. Thank you very much. Have a good night.